How contributing to a 401k actually increases your taxes and reduces your consumption in retirement. It's nuts, man. It's nuts. And this is for your overall lifetime consumption, by the way. The 401k, especially for middle class income earners, it does increases your taxes and reduces your consumption over a lifetime. And I'm going to show you the proof right here. You ready? So let's look at this. This is from an NBER working paper series from my man Larry Kolikoff. Look at that. Date line, June 2001. And you might be, Josh, why are we looking at a 2001 paper? Well, let me show you. So I'm going through my litany of various things, various reports, papers, all kinds, stack after stack after stack of stuff I've printed off over the last 20 years. I'm just trying to clean up after myself. And I came across this, one of the best papers I've ever read, actually. One that started me on my process of everything we've been told about financial planning is wrong. All right, so who are these guys? The authors are, let's see, Kolikoff over at BU, the National Bureau of Economic Research. This guy and this guy from the Federal Reserve Board of Cleveland. All right, so the title is, does participating in a 401k raise your taxes? And the answer is unequivocally yes, especially for middle class people. All right, so let's read this. Contributing to a 401k and similar tax-deferred retirement accounts certainly lowers current tax rates, but it doesn't lower your lifetime taxes. If average and marginal tax rates were independent of income and didn't change through time, the answer would be an unambiguous yes. The reduction in current taxes would exceed the increase in future taxes when measured in present value. But tax rates may be higher when retirement account withdrawals occur, either because one moves into a higher federal tax and state tax bracket, or because the government raises tax rates. In addition, reducing tax brackets when young at the price of higher tax brackets when old may reduce the value of mortgage deductions. Finally, and very importantly, shifting taxable income from youth to old age can substantially increase the share of Social Security benefits subject to federal income taxation. Assuming a and they talk about using the ESP planner software, the consumption smoothing software. Assuming a 6% real return on assets, we find that low and moderate income households actually raise their lifetime taxes, and lower their lifetime expenditures by saving in a 401k plan. In the case of a couple with $50,000 in annual earnings, partaking fully in the typical 401k raises lifetime tax payments by 1.1% and lowers lifetime expenditures by 0.4%. The lifetime tax hike is 6.4% and lifetime spending reduction is 1.7% for such households if they receive an 8% rate of return. The figure rises to 7.3% and 2.3% respectively, the increase in taxes and the reduction in consumption, if taxes are increased by 20% when the couple retires. The findings are driven in large part by the Social Security benefit taxation induced by 401k withdrawals. Shocking, huh? They talk about the picture is quite different for our high income earners, showing you that the 401k tax deferral is actually, it's a benefit for the wealthier, no other way around that. In addition to demonstrating the regressivity of the federal government's tax-deferred savings policy, our findings call into question Social Security benefit taxation as well as the non-discrimination rules that induce employers to encourage 401k participation by low earners. They also suggest that low and moderate income households should consider contributing at lower rates and for shorter periods to their tax-deferred accounts. Finally, they indicate that saving through a Roth affords a much greater lifetime tax benefit than saving through a 401k or convention IRA. Nuts, man. All right, so we talk about how we find that lower and middle income households who earn pre-tax return of 6% subject themselves to higher income taxes by fully participating in the 401k. The lifetime tax hike is 6.4% and spending reduction 1.7% for households if they receive an 8% real rate of return before they received a 6% rate of return. And if the feds raise taxes by 20%, you'll have a 7.3% increase in taxes for middle income and lower income earners with a significant reduction of spending by 2.3%. Talk about the picture is quite different for high income people. We already talked about that. All right, so let's just keep now. We show different charts and calculation stuff. We're not going to get into how they actually calculate this because I'm bored to death. But you can see all the calculations if you want. I will put links in the show notes if you really want to see all this stuff. And by all means, you should. But I want to point out this. How much of Social Security benefits are included in federal adjusted gross income depends on a pair of dollar limits. Let's call them X1 and X2. For single filers, these dollar limits are $25,000 and $34,000 respectively. For joint filers, they are $32,000 and $44,000 respectively. Interesting. These limits are not indexed for inflation, meaning that as nominal incomes rise, an ever large share of the benefits become subject to income taxation. This was written before September 11th, the September 11th. Fast forward today, those numbers are still the same. All these guys, we're out for the middle class. Not a one has changed this. Not a one. The only thing out there is whatever the 2100 rule or law that's out there. I forgot what it's called. That Devin, when he interviewed that congressman, nothing's out there to change this. Nothing. Freaking crazy, man. Middle class Joe, George W. Bush, all these guys, all bipartisan. They haven't done anything to change the fact that Social Security taxation hurts the middle class and lower income. That's all there is to it. All right, let's keep going down here. And you can read, they talk about how they use the software that Larry sells to calculate all this, the sales pitch for the software. I got no problem with software, but it's just what this is, so we're going to skip through that. All right. With 401k participation, the couple is severely borrowing constrained and must reduce its consumption dramatically when young in order to make its 401k contributions. Indeed, the couple's age 25 consumption declines by 24% due to participating in the 401k. However, the sacrifice in consumption when young permits a 277% greater level of consumption in old age. So essentially, they're reducing their income, their spending power by 24% while they're young in order to have almost a 300% in spending power increase when they're old. Is that a good trade-off? I don't know. It's certainly not consumption smoothing. Participation in the 401k also tilts the couple age income profile. With participation, income at 25 is 19% less, and income at age 65 is 241% more than if they did not participate in the 401k. So by not participating in the 401k, they're going to increase their income by by a quarter, essentially, while they're young, and they would reduce their income by almost 250% when they're older. Since this income is taxable, taxes are lower when the couple is young and higher, indeed much higher when the couple is old. Note that the couple is borrowing constrained when young, even in the absence of 401k participation. And the couple's regular asset accumulation, once it begins, is relatively modest because they're not putting that much money to begin in the first place because they're borrowing constrained, i.e. they're not making that much money. The explanation is that the couple is contributing so heavily to Social Security and receiving sufficiently large benefits from the program that the couple has little need or wherewithal to do additional saving. This picture, writ large, goes a long way in explaining America's low rate of personal savings. I completely, unequivocally agree with that. We are saving. It's just as through Social Security rather than private accounts because they're borrowing constrained. They don't have any else money other than to put into Social Security and a little bit into 401k, but they're still putting a boatload into Social Security. Table 3, which considers the gains from 401k participation, contains a number of striking findings. First and foremost results are that for low-income households who earn a 6 and 8% real return on investments, these households' 401k participation raises taxes and lowers spending. Take the couple with $50,000 a year in earnings that receives a 6%. We already talked about this. So, that's just nuts. The more they earn on their 401k, the more taxes they pay because that has accumulated tax deferred, but it will add to future taxes from 401ks and Social Securities, which actually means their taxes are higher and their consumption is lower. Why, according to Table 3, is 401k participation worse if a couple earns an 8% rather than a 6% rate of return? Why are they paying more taxes and less spending if they get an 8% rather than a 6%? Good question. Since participating in the 401k plan reduces capital income taxes, a higher rate of return would seemingly increase the benefit from participating. However, a higher rate of return implies greater asset accumulation within the 401k plan and thus larger plan withdrawals. For middle income and low income households, this means being pushed into a higher marginal tax bracket in retirement and or finding that more of your Social Security is subject to taxation. Table 4 sheds some light on why 401k participation can be a costly experience for low-income couples. It considers a couple with $50,000 in initial labor income, working income, and access to a 6% real rate of return. It then successfully adds Social Security, housing, children, and college tuition to the case. If the couple did not participate in Social Security, had no home, no children, and faced no tuition expenses, 401k participation would provide a tremendous subsidy. It would reduce lifetime taxes by over 1/4 and increase lifetime spending by almost 9%. But starting from the position, forcing the couple to contribute to Social Security dramatically lowers its 401k lifetime tax reduction to less than 5% and the spending increase to less than 2%. The addition to the case of housing, including a deductible mortgage, leaves a household essentially indifferent between participating and not participating. This, of course, assumes the household cares only about the present value of spending and not the timing of the spending. For as we've seen, participating in a 401k plan comes at the price of a major reduction in consuming when young. So you're saying, I'm going to consume less now while I'm married with kids and young and sprite, full of energy, and not making much money, so I can consume a whole lot more, 3 times more when I'm older and less shape and don't have any kids. Yeah, it's not a good trade-off for a lot of people. With the addition of children and their college tuition needs, 401k participation no longer saves taxes. It actually raises them. With children come additional tax exemptions. The tax savings from these exemptions will be reduced by 401k participation if participation lowers the household's tax bracket when young. Spending down regular assets for college tuition leads the household to enter retirement with relatively little income other than Social Security benefits. Consequently, it is in a position to have a taxation of its benefits greatly influenced by the amount of 401k withdrawals, as I've talked about a million times a Sunday. Table 5 shows that 401k participation lowers the federal's marginal tax bracket during middle age, but raises it at retirement. Without 401k participation, the household is nominally in the 15% tax bracket after age 65, but an additional $100 of earnings at this age generates an additional tax liability of $27. The effective tax margin rate is 27%. This occurs because less than 85% of the household's Social Security benefits are subject to taxation. An increment to earning triggers an increase in the amount of taxable benefits, making the incremental to taxable earnings $180. So an extra $100 actually leads to an extra $180 of taxable income. Thus a 27% tax bracket. For the $50,000 household considered earlier, the effective marginal tax rate in retirement is roughly 10 percentage points higher with 401ks than without. This is because the effective marginal tax rates rise from 27 to 31%, and the effective state rises from 0 to 5.5 in this Massachusetts in this case. Its large 401k withdrawals shift the household from the 15 to the 31% statutory marginal tax bracket and from 0 to the 5.95% state, a doubling of taxes. Crazy. Because of 401k distributions. That's what I'm saying. They make sure that your Social Security benefits are taxed, which they didn't. If you didn't have a 401k, you wouldn't have done that. For low-income households, waiting until middle age to begin participation is beneficial relative to making maximum contributions beginning at the age of 25. The same reasoning applies here as it does in Table 12. Smaller accumulations in a tax-deferred plan imply smaller future withdrawals. Smaller accumulation means smaller future withdrawals. This prevents taxation at a higher rate bracket during retirement. Households earning less than $50,000 now enjoy significant lifetime savings and non-negligible increments to lifetime spending from participation. So don't start at 25, start at middle age 40. less accumulation, less withdrawals, less taxation, more actually after-tax income you can spend. It's crazy. They talk about some other strategies there as well. It talks about contributing to Roth IRAs. Let's see. I think they say not all employers offer tax-deferred savings plans. For workers in such firms, access to tax shelter savings plans is limited to regular or Roth. Table 16 shows a lifetime tax and spending advantage from investing up to $2,000 limit in a regular IRA throughout one's working lifetime. The table assumes counterfactually that higher income workers are able to contribute the same amount to a regular IRA. In contrast, investing. Okay, they talk about how the Roth does much better. Oh, right here. Savings in Roth IRAs is done on an after-tax basis with withdrawals not subject to taxation. All within-plan accumulations are tax-free as well. Roth IRAs also eliminate the risk that plan withdrawals will be subject to higher taxes. Hence, savings in these plans confers a tax and spending advantage at all income levels. However, the pattern of gains remain regressive. The higher the wealth, the more beneficial. All right, so summary. Participating fully in 401k plans appears to raise rather than lower the lifetime tax payments of most workers, namely those with moderate and low incomes. While contributing to such retirement accounts lowers current taxes, the increase in taxes paid on withdrawal can exceed the immediate tax reduction when measured in present value. There are three main reasons for this. First, the size of the withdrawals can be large enough to place a household in a higher tax bracket, both at the Fed and state levels. Second, the size of the withdrawal can substantially raise the share of Social Security benefits subject to federal income taxation. Third, the size of the contributions can lower tax brackets when young and middle age, and thereby reducing the value of the current mortgage and other tax deductions. I cannot stress this enough. Again, you might not have a tax deduction because the standard deductions are so high. In fact, I would be willing to bet the vast majority of you out there don't have a standard deduction. I don't have itemized deductions anymore. So in this case, I did a video just a few hours ago, about a guy who had $4,300 in mortgage interest. He's not deducting that. He's married, filing jointly. He's not deducting that $4,300 mortgage interest. So that's a full cost to him. In the old days, you might have been able to deduct it, which you could say, hey, I can get a deduction off this $4,300, so my net is $3,500 the cost to me. In this case, the net is $4,300. And on top of the fact there, even if you're only 10 or 12% tax bracket, you're only able to write off 10 to 12%. It's no big deal. I mean, it's better than nothing, but it's no big deal relative to how much your tax bracket is going to be higher in the future. Your tax bracket is going to be significantly higher in the future because what Larry and these other guys say, you're sacrificing 25% a year in income today in order to have 300% in income in the future when you're on top of that getting Social Security, which means now your Social Security is subject to taxation plus the 401ks as well. So the lower and middle income class are paying more in taxes for 401k contributions. And this includes the employer matching as well. So the idea would be wait until you're in the middle age before you start putting money into a 401k. Or don't even do the 401k, just do the Roth outright. Something to think about, man. I'm telling you. Or just if you got a match, do your part in the Roth and let their part go into the traditional. At least you get to take advantage of the match. I hope you find this helpful as always. This, again, going back to my book, The Tax Bomb in Your Retirement Accounts, $9.99 on Amazon. You got to look at it outside the box. You got to look at it outside the box. All right, smash the like button. We'll see you next time.